Welcome to Wealth. I'm Allie Canal, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, we'll check in on oil prices after they jumped to their highest level since January. Our very own Ines Ferre will explain how that could impact your prices at the pump. And more Americans are claiming Social Security benefits. A financial planner will break down how you should look at those payments in your retirement planning. Plus, we hear from one millennial investor who is on her way to financial independence and retiring early, aka FIRE. She'll share how living below your means is the key to achieving those goals. All that and more on Wealth. But first, oil prices pulling back slightly this morning after seeing their biggest jump in 3 years last week, with crude up about 10% over that time period. So what might this mean for the price you pay at the gas station? Joining me now for more is senior markets reporter Ines Ferre. So Ines, there's that reporting out there that Iran wants to de-escalate tensions with Israel. That's helped push stocks higher, but crude remains just around $70 a barrel. So should consumers be worried that gas prices will still rise?
Allie, what experts are saying right now is in the short term, in the coming weeks, you may see a modest spike in gasoline prices and prices at the pump. You had Patrick DeHaan from Gas Buddy earlier today talking about that modest hike in gasoline prices. Also, Andy Lippo of Lippo Oil Associates saying that in the coming weeks, you could see a 10% rise in the price of gasoline. But it's very important what's happening with the price of oil because of course, all of this is correlated to that price of oil and that spike that we saw on Friday, the 7% spike. But today we are seeing oil coming down, and that's off of that report that you were just mentioning that Iran is looking to de-escalate this. So the markets may be pricing in here that this conflict may be limited. Right now, you're looking at the price of gasoline at $3.14 a gallon. That's up 2 cents from a week ago. But take a look from a month ago. It's down, and also it's down from a year ago, about 30 cents lower from a year ago. So even Patrick DeHaan of Gas Buddy was saying there's still a lot of room here because you are seeing that prices are significantly lower than they were 1 year ago. Of course, so much will depend on what happens with Iran and Iranian oil, because a lot is riding on that. If you see Iranian oil coming off of the markets, then you could see oil prices spiking more than $7 higher, according to some analysts. Also, if the Strait of Hormuz were to be shut down or blocked, then you could see oil going into the triple digits, into about $100 per barrel. So it all depends on what happens with this conflict between Iran and Israel. But right now, what analysts are saying is you may see a spike. It may be temporary spike in the coming weeks, but there's still plenty of oil. A lot will depend on what happens with this conflict.
All right, and there's a lot to keep track of. I know you'll be watching that closely for all of us. Thank you so much.
Thank you.
Let's take a look at some of the market action 90 minutes into the trading day. Stocks are rebounding following Friday's sell-off. And joining me now to discuss is Burns McKinney. He's managing director and senior portfolio manager at NFJ Investment Group. So Burns, thanks for being here. Let's start with the Israel-Iran conflict. Even with those reports of a possible de-escalation, do you think geopolitical risks are fully priced into this stock market? And if not, what could that mean for volatility moving forward?
The markets have really been behaving as though that there really isn't a long-term risk being presented. I think one of the things that the markets have kind of learned really ever since the initial Russian invasion of Ukraine is that every time we've had some sort of geopolitical conflict in the Middle East, and oil prices have spiked initially, but they've tended to pull back every single time, and it appears that investors have learned their lessons from that. Likewise, if you look at take a look at keys or hints from other areas of the market, despite the conflict between Israel and Iran over the weekend, you didn't see an investor flight to haven assets. You didn't see big investor demand for the dollar or for 10-year treasuries, and so the markets have been pretty complacent on this in the near term.
Yeah, that was an interesting thing to watch, that there wasn't this flight to safety. But there is a growing argument that an oil shock could potentially dent demand, possibly weaken the labor market, and ultimately force the Fed's hand. How do you view the current conflict's potential to accelerate the pace or even the number of rate cuts that we see this year?
That's a great point. I think one of the most important plays that this could at least affect U.S. investors would be, what does it mean for the coming Fed meeting? It appears that the meeting that the Fed has this week, they probably weren't lining up to cut rates anyway. But a lot of what the Fed's been doing is they've been patient. They've taken a wait and see, a data dependent mode. Just simply because of the fact that tariffs tend to be historically, or at least on paper, tend to be inflationary. It appears that the tariffs thus far really haven't had that type of inflationary effect. But then over the weekend, you have sort of the monkey wrench thrown in. Okay, we've been focused on what the tariffs will be doing for inflation, but now we have the potential for an energy price spike to also at least give the Fed something to think about, which all of which suggests that the Fed probably isn't in line to actually make any moves until sometime this fall. We do believe they remain ultimately in rate cutting mode, but where investors really should be focused this Wednesday is not necessarily what they do Wednesday, but what happens with the so-called the dot plot, the Fed projections. As of right now, I think, or at least as of the last meeting, that dot plot suggested 2 quarter-point cuts later this year. I think a lot of the forecasters are suggesting that having a lot to do with what's going on between Israel and Iran, that might actually become, one potential cut this year, which might cause the long end of the curve to pop up a little bit.
And as you were just alluding to, tariffs remain a big TBD factor for the Fed. We did see that Trump's pivot from those Liberation Day announcements that's fueled a lot of the market gains that we've seen. So realistically, though, you say that optimism has been priced into this market. Can we get higher? And if so, what are the catalysts that we need to see?
A lot of those catalysts have already taken place. As you saw, the market dipped back in April with what was really the quote, the Liberation Day announcement was what really one of the greatest self-inflicted policy wounds that we've seen in many years. And as investors have seen that, okay, well, you have a pain trade. The president has historically had a tendency to retreat when the market is kind of thrown up a little bit at bad policy announcements. And so a lot of what the markets are pricing in now, the S&P is basically back to where it was pre April 2nd, despite the fact that where we're ultimately likely to settle out is still with tariffs 4 times what we've seen in any of our lifetimes. And so a lot of coming deals and good news have already been priced in to the markets. And where we stand right now, we got the S&P trading at 21, 22 times earnings. It's more expensive than it's been 3/4 of the time this century. And so investors are probably going to have to rely on either just good old-fashioned earnings growth, which should be more muted for the rest of this year, or just getting returns from companies that are paying and growing dividends. So we're not expecting to see a 40-yard bomb down the field. It might just be 2 or 3 yards in a cloud of dust.
Burns, would you say this has been one of the most hated stock market rallies out there, considering where we're at with sentiment, yet we still have equities hovering near those record highs?
That's a great way of putting it. The investment community has basically just been dragged, by the heels along with this market rally. There really hasn't been a boom in enthusiasm. Last year, when the markets were rallying, investors really climbed a wall of worry. You had a recession that was bound to happen. Well, it didn't. You had an uncertain election. Well, we got a fairly certain outcome. You had geopolitical conflict. Well, none of that is necessarily escalated to elsewhere. And now we're really in a place where the policy news is kind of shifted. And if anything, we have maybe a wall of complacency in that we have a world in which the policy, certainly we have the tariff talk, but now investors are, maybe pivoting towards focusing on tax cuts, on deregulation. We do still have a Fed that is in rate cutting mode. And so a lot of the bad news has been priced in, and, we're probably in a place where a lot of the good news is as well. So that, investors really should just have to rely on the underlying fundamentals of earnings growth, which should be a bit more muted this year.
All right, Burns, thanks so much. Appreciate those insights.
Thank you.
Now time for some of today's trending tickers. We're watching Roku and Warner Brothers Discovery, and joining me now is host of Morning Brief, Brad Smith. So first up, Roku announcing an exclusive partnership with Amazon Ads to create the largest authenticated connected TV footprint in the US. That means everyone viewing content on Amazon and Roku systems and devices will be included in this pool. That gives advertisers access to around 80 million US households, according to the company. So Brad, obviously a huge play for Roku. We're seeing shares rise significantly off of this news. Same with Amazon. And it's interesting because usually in an environment where you have macro concerns, advertising is the first to go. So a little bit of risk there associated with Roku. But at this point, it seems like there's a lot of tailwinds for this company.
Well, you talk about one of the fastest growing parts of Amazon that actually doesn't get enough recognition within that advertising business. And so for the past few years, they've been making some strategic inroads. And I think this also signals how they want to be in more of the direct to consumer content hub in order to make sure that they're continuing to have partnerships that ultimately plunge them further into connected TV households. They mentioned that within this release as well. New collaboration delivering logged in reach to an estimated 80 million US connected TV households, representing more than 80% of the US CTV households, according to ComScore data here as well. And then they also had some early tests of the integration. They say that showed some significant results. Advertisers using this new solution reached 40% more unique viewers with the same budget and reduced how often the same person saw an ad, because how much do you get annoyed when you see the same ad over and over again? So reducing how often the same person sees an ad by nearly 30% and enabling advertisers to benefit from 3 times more value on their ad spend, which is something that advertisers and marketers want to.
And it's interesting because before this move higher today, Roku shares are pretty much flat year to date. Now they're up 9% thanks to the 9% gain that we're seeing here. So another space to continue to watch and track. But moving on, bondholders at Warner Brothers Discovery approving plans to split the company, dividing the streaming and studios arm from the cable networks. Bondholders also voted to buy back $37 billion in debt that came with the 2022 WBD merger. And Brad, I mean, this entire split announcement has just been so fascinating to me because it wasn't that long ago that we had this merger. And now that we're seeing this separation, it's basically CEO David Zaslav's admission that merger did not work. And you're seeing shares, rise on this news. The big question, though, is who are the buyers going to be? How is the market ultimately going to receive this?
This is where we're talking with some of the analysts, especially within this industry, about how many companies are thinking about the sum of their parts right now. And for this particular move to separate Warner Brothers Discovery into what they call 2 leading media companies here, streaming and studios being on one side here. And just to reiterate to those who did not see the news or us talk about the news last week, streaming and studios is going to be Warner Brothers Television, Warner Brothers Motion Picture, DC Studios, HBO Max, plus some of the film and television libraries, where on the other side, Global Networks is going to be some of the premier entertainment, sports, news television, and then brands around CNN, TNT Sports, US, and Discovery. And so all of those things considered, you think about how each of these businesses in the direct-to-consumer entertainment environment is using Netflix as the North Star on the streaming side. We had seen that really leveraged in some of the activist campaigns that made their way towards another entity in the House of Mouse over at Disney. And so even as you're trying to extract even more value from your end users, it's really talking and really a nod to how the sum of the parts can create even more strength potentially in the form of making sure that you get to a point where you're not having to rely on one part of the business to continue to fund a different part of the business in hopes of reaching those margins, knowing that the profiles of them are vastly different and they should be valued as such.
And you brought up a good point with Netflix. I don't think it would be surprising to see a lot of these legacy players try and join forces to compete against Netflix, which clearly is the cream of the crop when we think about content. I do think the linear network side probably will be bought by private equity, but the media side of the business, I think maybe a Comcast could come in here. Who knows?
You think we could see a mega team like we saw with the NBA, the heyday of the mega teams?
Maybe. I mean, I wouldn't be surprised. I mean, Netflix, everyone talks about it being number one. So what do you do to compete against number one?
We'll watch.
You have to, if you can't beat them, join forces, I guess. But Brad Smith, thank you so much. And you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, an expert shares key tips for improving financial and credit literacy in the U.S. That's next on Wealth. Financial services company Synchry found that 52% of consumers struggle to pay for their out-of-pocket medical cost, with 53% delaying treatment due to that cost. With that in mind, the company is launching a new initiative, the Ferre Financing Principles, to better inform consumers about their options for financing medical expenses. I want to bring in Beto Casillas, Synchry CEO of the Health and Wellness Platform. Beto, thanks for joining us today. Let's start broad here. What specific challenges do consumers face when financing health and wellness expenses?
Allie, thank you for being here, and great to be here with you. We've been helping consumers over 35 years in terms of being able to take care of their health and wellness needs and being able to finance that over time and giving them options for them to do it over budget. What they're facing today is that the cost of healthcare and the cost of health and wellness is increasing, while what they get reimbursed from insurance continues to be less and less, which means consumers are carrying a lot more of the financial burden, and the need to have options to help for these paying out-of-pocket expenses continues to increase. So we're a critical resource in the industry in being able to provide that for consumers. And like you said, today we're launching this educational resource, which I think is extremely important. It's one of a kind that I think it brings forth an initiative called Fair Financing Principles. And these Fair Financing Principles is a way for bringing more transparency for consumers to make a much better decision in terms of getting the care that they need when they need it, by providing ways for financing care and being able to do it over time, and that meets their budget.
So what are some of the tools available here that consumers can utilize to help their financing goals?
One thing that they have in terms of payment options is one thing that is clear is that it is not in lieu of insurance. We want consumers to maximize their insurance part of the equation. We want to make sure that they confirm that they don't have any federal assistance or subsidized care, and consider like healthcare spending accounts, HSAs, before they go into patient financing with something like care credit. Being able to provide different types of offers, or being able to do it over 6, 12 months, 18 months, 24 months on something that the consumer is responsible for that particular procedure, brings forth a way for them to be able to get the care that they need when they need it. Being able to have a simple billing statement in front of them so they understand when they need to do payments, when they have to do it by the allotted amount of time to be able to pay for the care that they need. And we have created a new payment calculator and a procedure calculator with over 700 types of estimates of costs of the most common type of procedures that are searched in the health and wellness and veterinary care in our industry, and being able to do it by zip code. So if they have a procedure that they're curious about, they can get an estimate before the cost on the Care Credit Financing Principle page can give that to them. Again, it's a great tool that we have come out. We've been doing this for many years, but we're doing it in a way that consumers are able to access these same tools that have existed for us and have been in our practice, in our business, and being able to do that in the comfort of their own home, in the comfort of their own device.
Yeah, sounds like very helpful resources there. Have you identified any groups that maybe are more impacted by some of these financial expectations, or perhaps face greater challenges?
Most people, a lot of our consumers do have insurance, and so they're going to face an out-of-pocket expense, whether it's at the beginning of the year when the out-of-pocket gets reset and their deductible gets reset at the beginning of the year, or later in the year when they actually are facing some emergency, or not emergency, but kind of out-of-pocket expense that they didn't anticipate. And so being able to do that, it carries everywhere. Everyone needs the care that they need, and being able to take care of themselves goes across the board in terms of being able to use this.
So what practical steps do you recommend consumers take to prepare for some of those out-of-pocket healthcare expenses?
One thing from the beginning is know what's available out there. If you're an employee from an employer, see what kind of offers they have as it relates to flexible accounts. See what you could be qualified for certain things that are out there from your insurance, or from different programs that are out there across many consumers that are offered through the government. And then in terms of being able to budget yourself, know that healthcare is going to be an expense. And so anticipating and being able to put some dollars towards savings and being able to spend that over time is a critical aspect of it. And then financing. You can get the care that you need if you're able to plan and be able to fit that in your own budget and being able to pay over time rather than doing it in a large one expense. We know that for Americans, you said at the beginning, around 50%, a $400 bill unexpectedly is tough to pay at once. And being able to finance that over a course of 6 months or 12 months, whether it's $400 or $2,000, is a way for them to get the care that they need and being able to pay it over time that fits their budget.
Beto, thank you so much. Appreciate those helpful tips.
Thank you very much, Allie. Great to be here.
Coming up, the number of Americans taking Social Security benefits has ticked up in recent data. Our next guest breaks down how claiming benefits early impacts your retirement planning. That's next. The number of Americans claiming Social Security benefits is on the rise, with the number of claims between January and May nearly 18% higher than the same time 1 year ago. And there could be risk to retirees' overall earnings if the trend continues. Joining me now in studio is Larry Sprung, the founder of Mitlin Financial. So Larry, this is really interesting. We're seeing this surge in Americans claiming Social Security benefits at an early age. 62, highest in over 2 decades. What's driving this trend towards early claiming?
I think it's really twofold. One is I think there's a fear out there, whether right or wrong, that Social Security may not be there. So people are like, let me claim now while I can. And then the other thing was there was some legislation that went through at the beginning of this year that now allowed people who traditionally were not eligible for Social Security because they were being covered by other benefits, that they are eligible for Social Security. So I think those two combined are really driving that increase in demand for benefits.
So what's the downside if you claim early versus waiting maybe even up until 70 years old?
Yeah, so I mean, there's definitely an art form to more than a science of figuring out what is best for you. But essentially, most people, let's say your full retirement is age 67. Every year early, you take that the distribution. It's an 8% decrease. So if you start at 62, you're taking about a 30% haircut to your benefit. Versus waiting till age 70, you'd have about another 30% higher than you would at age 67. So there's a huge range of what your benefits could be. So it's really important that you understand when you should actually pull the trigger for those benefits.
So it pays to wait in this case, for sure.
It does. Most people are not getting 8% on their money while they wait. But at the same time, you have to weigh that with the fact of, can you wait? Do you have enough income from other sources to support yourself during that period of time?
And you alluded to this, but this was a stat that stood out to me. Over 75% of Americans under 50 believe Social Security won't be there for them in full. So how real is that concern?
So I think there's some validity to it because there's definitely strains on the system. But I will tell you this, I've been in this profession for over 25 years, and I've been hearing since I got into the profession that Social Security was going to run out. We haven't yet. We are on a path to potentially drain that pool of money for Social Security benefits. But the reality is we have seen them make adjustments along the way. For example, they've raised the income requirements to which you contribute to Social Security. So that's how they really have kept the pool up. They've increased the retirement age. So I don't foresee it going away completely, but I definitely see some changes to the structure coming in the future at some point.
So let's say Social Security is significantly reduced or maybe disappears entirely. What are some steps that folks can take now to prepare for that?
So I don't think, just to be clear, I don't think it's going to disappear and go away entirely. I think it may prolong when you could start taking benefits, and there may be some small reductions there, or it may be mean tested. There might be a various number of things there, but you really have to plan. You have to plan for your future, include Social Security, and even include a decrease in benefit to see if you can survive and your retirement works with those numbers. You also want to prepare, if you're in that under 50, try to work on some other means of income for when you do retire, whether that's saving additional monies in non-retirement accounts, whether that's having a side gig that you have some kind of side income stream for, or some other method of means that you have income coming to the household if you decide to stop your full-time job.
What about for younger Americans? What should they be doing to create a really strong foundation and a diversified retirement portfolio and plan?
Start early, right? Listen, I have 2 boys. They're 19 and 22, and I started them at the age of 14, starting to save for their retirement. A lot of people are in summertime right now. Their kids are working. If they have a W-2 job, they can open up an IRA today and start saving towards retirement. They probably don't need a tax deduction. Open up a Roth IRA. Take advantage of those extra years of compound interest, and maybe if Social Security is significantly reduced, maybe you won't need it as much because you started planning so much earlier.
Some great advice, Larry Sprung. Thank you so much. Appreciate you being here in studio today. Coming up, what is living below your means and how could it be your key to retiring early? We speak to a personal finance expert about just that next.
Usually eventually you have to pay them back. Yeah, all week we're giving you everything that you need to know about paying back this money, and today we're breaking down the difference between paying off federal and private student loans. For that, we have Scott Buchanan, who is the Student Loan Servicing Alliance Executive Director. Scott, good to have you here with us. So let's start by explaining the difference between federal and private loans.
Yeah, thanks, Brad, for having me. The difference is primarily who is the lender. Federal student loans are lent directly by the federal government using money from Treasury, and private education loans are generally made by banks or other financial institutions using sort of private credit. They're very similar in the private education loans to other consumer credit, like credit cards or mortgages or things like that, where there's a test of credit worthiness that the lender will make, as opposed to the federal student loan program, where generally it's a federal entitlement. And so if you're going to school, have filled out the FAFSA, then you're entitled to get those loans.
How should borrowers approach federal loans?
Listen, federal loans are incredibly flexible in terms of your repayment options. You need to know what kind of loan you have. Do you have a unsubsidized loan? Do you have a plus loan or things like that? Because they can have different benefits. But there's a lot of options, including forbearances, deferments, income-driven repayment plans that can all dramatically adjust your monthly payment amount. So something you need to always look at is the total balance of your loans, and thinking about, even when you're in school and thinking about potential repayment, remember you're going to have to borrow over the course of 2 or 4 years, and think about that in your repayment options.
What about private loans? When should borrowers consider applying for them?
Listen, you should always apply for these loans as early as possible. Once you get your federal financial aid award letter from your institution, talk to the financial aid office, make sure you've maximized any institutional aid that you can possibly get that would reduce the amount you have to borrow, figure out how much federal loan availability you have, and then determine what your gap is going to be, because the federal loans may not cover all your costs, and that's when you might turn to a private education loan. And doing so earlier is better because you can shop around on private education loans and find a lender who's got the best offering for you in terms of an APR and the best sort of program options that are available under that loan.
So what should the plan of attack be for repayment?
Yeah, well, listen, make a budget, like all financial things. You need to know in advance. Like, that's sort of the advantage of sort of going to school and having this period of time generally when you don't have to make repayment. You have plenty of time to put together sort of what your plan of action is going to be when you graduate and leave. So, number one, don't overborrow in the first place, as I always say. But if you have already borrowed, then make sure that you sit down, figure out each monthly payment that you're going to have, the differences between your federal and your private loans, because they're going to all have different monthly payments, different interest rates, and then put together a budget, a plan of action about how you're going to do it. Remember, when you first graduate, your income is likely to be a lot lower than it will be in the future. That's when you need to talk to your federal loan servicer and say, hey, here's my financial situation on the federal student loans. How can I lower my monthly payment, or how can I meet this budget that I have today? And they're going to have a lot more options. Whereas on the private loan side of things, it's going to be relatively set about the monthly payment.
If your loan has gone into default, what are the steps that you should start to take to make sure that you get back into good standing?
Yeah, well, that's very different between federal and private loans as well. But on the federal student loan, once you've reached 270 days delinquent, your loan can go into default, and that's when you need to call the default resolution group at the Department of Education. They will reach out and let you know that you're in default, and your servicer will as well. But that's who you need to talk to. There are lots of options, including rehabilitating the loan, potentially consolidating the loan, because getting out of default is something that you definitely want to do. And that's why loan rehabilitation would probably be your best bet on federal student loans, because that removes that default from your credit history. On private education loans, it's different. That's why you need to be very mindful about keeping on top of those private education loans, because once they go into default and charge off, there's not a whole lot you could do other than sort of negotiate a settlement or potentially a repayment plan to try to resolve the total amount of that debt.
And so once you have finally gotten to the point where you've fully paid off your student loans, then at that point, how are you kind of able to take advantage of, are there tax advantages as well that you should be making sure that you're also reporting?
Sure, absolutely. There's a federal interest deduction on student loans that you can take advantage of potentially. Now that is tied to income, so the higher income you are, the less likely are you be able to take that benefit. But you should definitely, during all of your repayment, make sure that you're as you're doing it in TurboTax or working with your accountant, make sure that you calculate the amount of interest that you pay. You'll get a statement from your loan servicer, just like you get W-2s and other things from your employer, that will tell you how much interest may be eligible, and you should definitely take advantage of that.
Let's get a check on the market action. We are seeing stocks bounce off the lows that we saw on Friday. Gains are being led by the tech-heavy NASDAQ composite. We are up around 1.5% there. The benchmark S&P 500 trading at 1.1% above where we were up Friday. And then the Dow Jones Industrial Average is up about 0.9% here. So more of a risk-on appetite here for stocks. And you're seeing that in the prices of Bitcoin too. We are trading closer to $108,000 a coin. That fell a little bit after we saw that escalation of the Israel-Iran conflict. You're seeing the bond yields, they're pretty much flat here. The 10-year yield trading at 4.4%, the 30-year yields at 4.9%. The dollar also continues to be under pressure, still below that critical 100 level. We know that the dollar has struggled, especially compared to other currencies out there. And finally, crude oil. I mean, this has been the biggie that Wall Street has been focused on. We are still above $70 a barrel, but significantly down from some of those highs that we saw on Friday here. In Wall Street commentary, there's basically two ways that this could play out. If we see a sustained move higher in oil, that could potentially dent economic growth. That could hit the labor market and potentially force the Fed to act and cut interest rates. On the flip side, higher moves in oil that could trickle through into gas prices. It could exert upward pressure on inflation. And if inflation is higher, that means the Fed is going to stay on hold higher for longer here. So it'll be interesting to see if Jerome Powell talks about those oil risks on Wednesday at his policy meeting and press conference. Well, moving on, the movement to gain financial independence and retire early, also known as FIRE, may seem like a far-off dream for many. But since the early 1990s, a growing number of people have made this their life mission. Our next guest is aiming to become work optional in her 30s, and she's here to share one of her key secrets to getting there. Joining us now is Michela Alocca, founder of Break Your Budget. So Michela, you're on that mission to become work optional. I love that. What first drew you to this FIRE movement, and how does it shape the way that you live and spend today?
Absolutely. So I actually had no idea what the FIRE movement was until I shared that I reached a net worth milestone on my Instagram. And I had so many people come to me saying, oh, are you planning to retire early? How did you come to this conclusion? And that really started interest for me in learning more about financial independence. And so I ran some of my numbers. I did a little bit of math and I realized, whoa, I actually could retire a lot earlier than I was traditionally told, which is around 65. And it has completely opened up my world to understanding that retirement is not an age, it's actually a number in your bank account. And if you just do a little bit of math, it's very likely you can retire a lot earlier than you think. But it does require some intentional lifestyle choices. So it's a trade-off between how you want to live today and when you actually want to stop working.
So let's talk about those choices, because FIRE isn't just about making money, as you say, it's also about managing what you have. So what does living below your means actually look like?
Yeah, so really it means avoiding lifestyle creep, right? So as you are going throughout your career, if you're making more money, the goal is to aim to hold your expenses steady or avoid increasing your expenses at the same rate as you are increasing your income. Because if you're making more money year over year, but you're also increasing your expenses year over year by the same amount, you're not really going to be seeing that financial progress. The goal is for you to make more money and then use the difference to pad up your investments and fund your retirement, whether that be at age 65 or hopefully for many of us much sooner.
So what are one or two habits that you utilize that really helped you in achieving this?
Yeah, so the big one is tracking my expenses. I think if you are not tracking your expenses, you are spending more money than you actually think you are because your brain is hardwired to protect you. So you will lie to yourself about how much you're spending if you are not writing it down. And that is something I feel very, very strongly about. But the other is just being really thoughtful about the lifestyle and living decisions that you make and evaluating them within the context of your budget. So every financial decision that I make, whether it be moving to a new apartment or purchasing a car or, even going out and shopping and buying new clothes, I'm looking at those expenses within the context of my broader budget so I can see what's the impact on my monthly spend? How is this going to impact or erode my savings? What would be the impact on my annual spend? And is this going to have a broader impact on my actual retirement plans? Having a budget and managing your expenses is super, super important. And then when it comes down to little stuff, like I mentioned, it could be being more aware of what you're spending on shopping or clothes and focusing on wearing the clothes you have. I also love to cook at home. I know that that can be a little bit of cliche advice, but it does make a huge difference if you are meal planning and aiming to keep your grocery budget a little bit lower. Every dollar counts, and every dollar in my mind can buy you a day or a week or a month of retirement, which I think we all want.
I agree. Whenever I cook at home, I definitely save more money than when I go out. But there has been criticism out there when it comes to the FIRE movement. What do you say to those skeptics and some of the biggest misconceptions that you hear about what you're doing right now?
Yeah, well, I think when it comes to the FIRE movement, there is a spectrum of people who take the really extreme approach and people who take a little bit more of a balanced approach. I treat it as a work optional plan. I try to avoid the term retire early in general because it has such a negative connotation with being super, super hyper frugal, almost to a fault. However, I will say that when it comes to making any type of financial sacrifice, more often than not, those financial sacrifices are temporary. And, maybe it's a couple of months where you're pulling back on eating out, or a couple of months where you're being super strict about tracking your expenses, just so that you can move the needle forward. Financial progress happens a lot faster than we think. Like, you don't have to be so hyper frugal forever if you want to retire early. It might just be a year or two where you're taking your finances really seriously, you're focusing on increasing your income, and you're making that progress. And so I would challenge everyone to run the numbers because the numbers are likely very different than you think, and you can probably retire a lot earlier than you imagine.
Run the numbers. Great advice. Thank you, Michela. Appreciate it.
Thank you.
Coming up, we dive into the hidden costs of being a caregiver. That's next on Wealth. Millions of Americans are family caregivers, and it's taking a financial toll. 95% of those caring for a family member are worried how it will affect their ability to retire. That's according to a new study from Edward Jones. Here to discuss how caregivers can navigate their financial future is Vanessa Okuraiwe, principal at Edward Jones. So Vanessa, this study found that nearly half of Americans expect to become caregivers. To give us some perspective here, what kind of financial strain does caregiving typically put on individuals and families?
Yes, a lot. So what we're finding is, most people do have concerns about their financial futures when they're caregivers. We're finding that people have to reduce their hours at work. Some of them have to step out of the workplace full time, are taking on debts, dipping into their own personal savings. So there's a lot of financial insecurity that this can create for the caregiver later on in life. We're also finding that there's the emotional strain, which of course is linked to the financial side of things, where people who are caregivers are more likely to report being stressed, higher levels of anxiety and depression. And at the same time, there is that personal fulfillment that comes with being a caregiver. Many people in the study said, well, I really appreciate being able to take care of my loved one. So all of these things, difficult as they may be, can be true at the same time. We just need to find the right resources to support this very crucial role that caregivers play in society.
So what would those resources be?
Well, first of all, it's really important to have a financial advisor who can act as that utility player, a financial advisor who gets you, who guides you, who can holistically understand your entire financial picture and is able to act as a navigator through all these potential challenges that one may have to navigate being a caregiver, whether that is navigating through Medicare or finding the right counselors or right facilities in the local community. That's what a financial advisor can assist with. And more importantly, create the financial plan that you need, which enables you to put on your own oxygen mask first before being able to care for others. The other important consideration is employers. Now, employers can do more to create more flexibility in their work arrangements. We all know that when you're a caregiver, being able to just pop out and offer care to that elderly relative or that person who is disabled is really critical, and it's not linear. And then the last thing on this would be around government legislation. We found in the study that 70% of Americans support bipartisan legislation that allows caregivers to contribute more and additional savings towards their own financial supports.
And speaking of legislation, Trump's immigration crackdown threatens to impact home health and personal care aides. That's a workforce that's already understaffed. How do you anticipate that will affect the caregiving landscape at large?
Well, we all know that, of course, there is a lack of support when it comes to caregivers. We have over 50 million Americans acting as unpaid caregivers, and we don't have the right infrastructure, or not enough of the right infrastructure to help support those people who give care, which is why the government support is absolutely crucial. We have 2 pieces of legislation right now that are going through that enables caregivers to really ramp up the financial support that they need. And we would also say with caregivers, it's important to ask for help. They're more in the community, more in the family, more in the workplace that can offer the right support to help make the best of the situation. Because at some point in our lives, we're either going to be caregivers or need to be able to give others that care and assistance.
Hey, Vanessa, thank you so much. Important topic. Appreciate it.
Thank you.
Well, that's it for Wealth. I'm Allie Canal. Thank you so much for joining. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern.